Hey, hello, and welcome to the GRadulting Workshop Series. My name is Debbie McCutsky, and I am the Coordinator of Services and Programs for Graduate Student Legal Aid. I use she, her pronouns. So on behalf of the Grad Legal Aid team, welcome to the first workshop of the 2023 spring semester. I'm happy to see those who are here with us on Zoom. And I know that some of you are watching this on YouTube. So today's workshop is all about money. How can I invest on a limited budget? But before we address that question, I want you to know that Grad Legal Aid is here to help you. We offer several services, and you've already paid for these services because you've paid your graduate student fee. So use us, keep us busy. So what do? Grad Legal Aid, we've got an attorney on staff who handles general legal questions. We have an immigration attorney that we contract with. We've got 2 advocates on staff who help students who've been charged by the university. I'm a notary, so I can help you with that. And of course, we have these workshops. Today's the first of 9 workshops this semester. So take a look at our website. You'll find lots of information about what we do, as well as instructions for how to request an appointment. So now just a bit of housekeeping. Automatic closed captioning has been enabled for those who want to read along. Near the end of the workshop, we'll post a link to a survey because we need your feedback. We will email links to the survey, the recording, and any handouts this afternoon. And those links will also be posted on our website. And let's see. And of course, during the workshop, we welcome your questions and your comments. You can post them in the chat for everyone to see. And if you want to speak with us, you can just raise your hand and we'll call on you. So let's get started. I am so pleased to welcome a brand new speaker to the GRadulting Workshop Series. Her name is Debbie Major, and she is a certified retirement counselor with Evergreen Retirement Services. So welcome, Debbie, and take it away.
All right. Thank you, Debbie. And thank you guys for coming today. And we're going to talk about investing. Our title is How to Invest on a Tight Budget. And I am going to go ahead, and I noticed I was just saying before we started that my computer is behind a window, and the sun came out today in Cleveland, Ohio, where I am located, and so it's washing me out. So hopefully you'll be able to at least follow along and see what's going on. And yeah, if you've got questions or anything, you can put them in the chat, and we'll try and keep up and do them as they go along. Either I'll see them, or Debbie or Simone will see them. So let me see. All right, so this is, okay, so we should be seeing how can I invest on a tight budget? Yes? Okay, and just mine. All right, so first of all, I am from SOFA, which is a nonprofit organization. It stands for the Society for Financial Awareness. I am located, like I said, outside Cleveland, Ohio. I have been in the advising business since 2008 when I got my insurance license, and then I went from there. In 2010, I went full-time. This is my second career. I was an elementary school teacher for 17 years before that. So SOFA affords me a nice way to be able to do education, as well as keep in touch with that, as well as helping others, which is so all my teacher things get to come into play too, as well as my knowledge that I've learned along the way. All right, so thank you for joining us. A little bit about SOFA, what our mission statement is. We don't offer financial products. We don't represent any companies. There are no products mentioned today, but any advice that's given is just for informational purposes, and it's things that that I would just tell you. But we'll talk about different kinds of investments and things like that, but nothing in particular or specific. Nothing is actually obviously endorsed by SOFA as a 501c3. We have been around since 1993, which is great because it's a big anniversary for everyone. And our founder is really excited about this 30 years. And that brings us to our evaluation form, and I'll bring this up at the end. But this is, being that we are a nonprofit, it's really important that we, and part of being nonprofit is that we should have to let the government know that we are sharing our knowledge with people out in the community. And we do that and prove to them by showing them evaluation forms and letting them know that we collected them and did them. It also gives a good chance for us to get feedback on what you liked, what would be a good topic for the future. There is an option if you have specific questions that we can't answer here and you want to ask me, you can schedule a time to have a 15-minute chat. And then if there's anywhere else you might think that might benefit from having one, that is there. I made up a jot form of this, and Simone will put the link in the chat so that you can click it if you have to leave early or before the end or at any time to be able to fill it out and just answer those questions. I would really appreciate it. That would be great. So that's all kind of my housekeeping here. All right. And when we talk about investing or talk about anything, especially with money, it's such a personal topic for a lot of people. And so the first thing to do is we want to know ourselves or know yourself, know where you're coming from and what you're comfortable with. And to do that, we want to make sure that whenever we decide that we might want to invest or we might want to do something with our money, you want to set realistic expectations. You want to know how risky you're comfortable with and how, and we'll talk about that today. You want to know the time frame, like how soon do you need this money? You know, is it an emergency fund? Is it something that I don't need to touch for a long time? And then, of course, budgeting and managing debt, which I'm going to make a prediction that most of us at this time, or most of you at this time in your life, that is managing debt and budgeting is going to be one of your top priorities. And, you know, when you bring up budgeting, a lot of times when I talk to, you know, clients that come in and I say budgeting, I get something like, you know, an ugh, you know, or do I have to, or I know I have enough money, or I know there's something left, or I know there is something left, something like that. But not a lot of people really want to budget. That's not one of their favorite things to do. And I don't blame them because it can be a hassle. And sometimes we don't want to see, or as long as we don't know where it's going, we don't have to worry about it, right? But the reason why I put this slide in here for the budget, because this is what I like. So, and it's this part right here. So if we keep in mind that, you know, 100% is what we bring home, these are good percentages to just put out there. 70% of our money should be going toward living, and this is our net that comes home because obviously taxes and things will come off on the top. 70% would be to living expenses, 20% toward our debt, and then 10% would be toward ourselves, paying ourselves first, or long-term savings, wherever that would be that you would like to have it go. This obviously can change throughout life, but this is a nice way to at least think about something easily and think about it easily. So it's something to kind of gear it for. That's an easy way to figure out whether you're reaching it or not. All right. So what kind of investments can we have? Let me catch up on my, oh, actually, let me go back because I missed that we wanted to do the first poll at this time. So Debbie, I made up a couple polls, and if the first one, if you could put up on the screen, that would be great.
I can do that. I just want to let you know the poll questions all will be together. I didn't expect to separate them. I'm sorry.
Oh, well, that was probably my fault. I should have clarified that. Well, you know what? How about, well, go ahead. We'll go ahead and we'll just do them all now.
Launch it now?
Yeah,
okay.
And then we'll just refer back to them. So
okay, thanks. Sorry about that.
Oh, no problem.
All right, so 3 questions are up.
Okay. So this, yeah, I can only see one at a time anyway, so.
If you scroll down on the right.
Oh, okay. So the first one asks, Okay, yeah. So the first one says, well, what is your investment experience? So would you consider yourself to have no experience, little experience, some experience, or you're very experienced? So you just pick one of those. The second question is, which of these investments would you consider the riskiest? So you pick which one. And let's see. And then the last one is, would you take on the same amount of risk for an investment with a short time horizon as you would for an investment with a long time horizon? And that's just yes or no. And let's see, it looks like my mom at 75% participated. So let's see. I've got to see some.
Yeah.
Okay, I do see a mixture of answers on the second one and on the first one. The third one seems like we've got all the same answer there.
Okay, I'll end the poll
All righty.
and then I can show the results.
Okay. Oh, great.
There we go.
Okay, wait, is this the one that you,
These are the results.
okay, you can see them on your screen too?
I can see them. Can you see
Okay.
them?
All right, perfect. Well, I wasn't sure because sometimes with Zoom, when I've looked at a different screen, I can't see the people on one screen and people are lost on the other one. So that's why I just want to make sure.
Yeah, I get it.
So it looks like for investment experience, a lot of you are in the no experience, and then we've got a couple that have little or some experience. That comes into play when you do the risk questions later on. They usually always ask you how much experience that you've had in investing. Sometimes they weight it and they give you some points with it. Other times no, and it makes a difference. Usually no experience, you really haven't done anything. Limited, I usually say, well, if you've been in your corporate 401k or anything like that, you for sure have some experience. You can't say none because some people will still want to say none, and then some. So that's great. So this will all apply for you guys. And then which of these investments would be considered the riskiest? And I threw this in because sometimes people would get this wrong, and actually most of you got it exactly right. So we've got the choices of gold, money market, individual stocks, mutual funds, or corporate bonds. And you're correct. Individual stocks are, and that's because you're owning one company if you're owning an individual stock. So that company can grow and become big and you can make a lot, or it can go bankrupt and out of business and you lose everything that you put into it. And that's why it's the riskiest. Mutual funds would be up there as being risky on the risk category, depending on what kind of mutual funds you have. But in mutual funds, they own hundreds or thousands of individual stocks. So if one company goes out of business, you're not out of luck completely. And then corporate bonds, if you bought something like a junk bond, it would be pretty risky, but it still wouldn't be as risky as owning that individual stock. So that's great. And then would you take the same amount of risk for an investment with a short period of time horizon? And everyone got that one right. No, you would not take the same amount of risk. And that's perfect because that's what, that's one of the things that we talk about. All right. All right. Let me see. Now I can just X that out, right? Okay. Are we back to just my screen? With the
I think so.
okay,
Yep.
perfect. All right, I'll go back here. And Debbie, I will need your help with checking for chat because I'm not sure where to click it from how many different screens I have going right now.
Not a problem.
I've got two that are showing Zoom and I've got one that's the background. And so I'm like, if I hit the chat, I don't know what might happen. So, all right. So types of investments. So this is a list. It's not from least risky to most risky, but it does start with one of the safest things that you've got, and that's your certificates of deposits, because those are from the bank. You know what you're going to get. Right now, rates are still pretty low on those CDs in the banks. So you're not going to make inflation right now with those CDs. Then come our bonds. Bonds are when someone lends us money. So either the companies are going to lend us money and they're going to pay us interest, and that's how we get our payment. Then we get our money back after a certain number of years. And that'd be the corporate bonds. Municipal bonds are with your governments, local governments. When they need to raise money, a lot of times you'll see them for roads, construction kind of things like that. And then we've got our federal government and state governments that have their bonds also. treasury bonds, and that's when we're buying. So we're actually lending the government money and they pay us back. So those are bonds. They're considered pretty safe. They're called fixed income investments because you can get the payments paid to you each quarter or each year. Then there's stocks or equities. That's the other name that you could call them. When you put them all together, stocks and bonds, you end up with mutual funds. Life insurance and annuities, to be considered an investment, there's what's called variable life insurance and variable annuities. And what they have inside are sub-accounts, which are mutual funds. So you'd still be investing in things that are related to the market and have market risk, and then which means they can go up and down and they can be volatile. Fixed life insurance, like cash, that has like cash value life insurance where you pay money and you just have you know how much you're going to get, and it grows inside. That's not considered an investment. That's a safe place to put your money. And fixed annuities are not considered an investment either, because you know what interest rates you're going to get. But they are all different places that you could put your money that are the most available that most people use. Some investments that are a little less used would be things like real estate. Clear my screen. And this wouldn't be like your home real estate. This would be rental property real estate or commercial property real estate. Things like collectibles, your stamps and your art and your coins. Then there's hard assets like gold. Gold always seems to gain popularity when the stock market's going up or down, especially when it's going down. People would say it's a hedge against all of that because it's a hard asset. It is very volatile though, and you have no guarantee of making money. It just may never go to zero, I think is what the big thing that they say about it. And then of course, what's not on here would be your crypto, which is new, very new. And you can see writing with my cursor is not as great. Crypto is a form of currency, and so it's more like a monetary, but it's very volatile. And if you've watched it at all, you know people got in, then Bitcoin went way up. People are making money. They've got all these Dogecoin and all these other coins that people came out with. They were going to use them in different places, and then through the pandemic, things changed, and then it had a big plunge all of last year, and then the guy's now in trial for ripping people off on the crypto. So, you know, it's brand new. It's not regulated at all. So it's kind of like the wild, wild west out there. I don't recommend it unless it's truly something that you really believe in on your own and you want to, and it's money that you can, don't have to worry about. But for the most part, when you go to invest, you're going to look at the three traditional asset classes of stocks, bonds, and cash equivalents. And that's like your money market types of accounts. When you're looking to have where you're going to gain the most money, stocks are going to be your tend to make more money over a long period of time. Bonds have less risk and more conservative returns. And then cash equivalents, money markets actually usually just stay right around $1. At least that's the way they've been for about the past 10 years. They used to be interest bearing. That may come back since the interest rates are going up with the Treasury. But I still haven't seen much in the way of money market accounts. People just kind of park their money there to be safe. So why is it important to think about asset classes? And before actually I go to the next slide, there was a question that came in beforehand when you signed up for the webinar, for the workshop, about investing and when should you start investing and things like that. And the answer would be as soon as you can. And the analogy is that we use is, if you think about, you've got a destination to be somewhere and you need to be there by a certain time. So if I know I've got to be somewhere at 2 o'clock and it's 1 o'clock, I know I have to drive 60 miles an hour to get there by 2 o'clock. But if I wait until 20 after or 15 after, I've got to go like 90 miles an hour just to get to that same place and be on time. And that shows you the power of time. there's nothing that beats time. So the younger you can be to put in something, even if it's a very small amount, the better off you're going to be than trying to wait until you're 40 or 50 and say, oh gosh, now I'm thinking about retirement. Now I need to put some money away for myself. So even carving out something is better than nothing. You can always start, if you have to, that you can even start with your having them sweep from your checking account to a savings account, a certain amount every month until you get up enough that might be a minimum that you need. And I'll talk about that a little bit at the end. But time and compounding interest are on your side. And compounding interest means you're making money on the interest. You're having interest credit to your account. And then as that grows, whatever interest is coming your way is going on that whole amount, that's that new amount that's there. And you just, you can't beat that with time. There's no way you can make up for time. That's the one variable you can't make up for. And so when you decide that something is going to go in, and you look at the asset classes and you say, well, okay, now how do I know where I'm going to put it, right? Well, you certainly don't want to try and pick. It's really hard to pick winners and losers. In fact, we really can't. So I like to share this as a nice, colorful little periodic table of investments. And what this is it's just showing all of the different asset classes that you've got. And what's high one year and the winner one year may be the loser the next year. I came in in 2008. And if you remember what happened in 2008, we had the Great Recession and the stock market went down 43%. You can see fixed income did the best. That would be your bond that year, which makes sense if the stock market was down. In 2009, if you stayed and you saw, wow, here's emerging markets, that's going to be your countries that are small and growing. That was just went like crazy. The first year I was in, everybody was talking about, oh, you got to get into emerging markets. You got to get into emerging markets. Well, emerging markets is one of the most volatile and up and down market allocations you could have. And if you were to go and put your money there in 2009, by 2010, you would have lost like almost 16% of it. And then look at this, by 2011, it was down 18.42%. So you've lost a whole bunch of your money by following whatever was last year's winner. So we never can pick last year's winner or this year's winner based on last year's results. And all we have to look at is last year's results. So we want to make sure, it's really important that we find the right mix for our investments, and we get off that roller coaster of ups and downs that the market does. And there's three things that you want to look at. You want to look at what you want to expect, what you want to receive, your time horizon, how long is it going to be in the market, and then what your risk tolerance is. So diversification versus asset allocation. Both of these are terms that you're going to hear a lot, that are ways that you can minimize risk. So, which is the big thing. If you're going to be in the stock market and you're going to invest in equities, you're taking on risk. And so how much risk can you take on? So diversification refers to the different kinds of companies that you're going to own, and asset allocation is more like that Callan chart that we just looked at, where you pick a certain types of assets that are all kind of together, like the emerging markets or large cap companies or small companies or bonds. And you have a mix of those and you put money toward each of these types of allocations. Or in diversification means you look inside those allocations and you just make sure that you don't own all the same companies within that asset allocation. And both of them help to lower risk and kind of control risk. Nothing gets rid of risk all the way if you're in any of these investments, but we want to control it so that when the market is down at 43%, our portfolio may only be down 23, or like last year when it was down 24%. You know, a lot of my clients were right around, we were 15 or 16. So it was depending on how aggressive they are as an investor. So it doesn't ever eliminate risk, but it does help risk. And it's important to know, no matter how much you put in, that's what you want to be going for. And that's why I bring it up, is you want to be going for asset allocation.
Excuse me, Debbie, we have
Yes.
a question.
Okay.
We have a question from Michael and he says, what about ETFs?
Oh, okay. Well, ETFs are an inexpensive way for you to invest into the stock market. So it's going to depend on what kind of ETF you have. So if you buy one that just follows the stock market, the S&P 500, it's going to be as volatile as the stock market is. So if the smart it's way up, it's up. If it's down, it's down. What ETFs have been good for is a low cost way to just follow, to be able to buy like an index and a basket of investments, so that you can well, do it inexpensively without and have the whole basket like a mutual fund. So it's like it is a mutual fund, but it's much less expensive, and they are actually traded. That goes along with index funds, which are funds that are put together just to follow an index, and it's called passive investing instead of active investing, which is kind of more than the scope of this workshop, but it's the same kind of idea, where you just put the money in and you just let it grow and let it do its thing. It's a low expense, because mutual funds can be expensive depending on how much the manager is buying and selling all of the stocks inside or the bonds inside. And if they're doing if there's a lot of turnover, if there is a lot of buying and selling, it can make the internal costs much higher inside of a mutual fund. Right. I hope that answers it. Is there any other ones, Debbie?
And Michael adds on a question. So it's more towards long term.
If that's what it depends on what your goal is. You can use it for shorter term. Like by shorter term, I mean 5 years, 6 years, which goes right along with that second bullet point here. A separate portfolio should be completed with each investment, because you can put money in an investment. Say, I want to save money for a down payment for a new house. It's going to be in 5 years. You can use an ETF. You can use ETFs. You can use mutual funds. You can use index funds. You can use anything of those things for that, because you still have a time horizon. You're going to own it for more than a year. So as long as it's more than a year, more than a couple of years, and it's not your emergency fund, then that's as long term as you would need it. You just want something that would be, just make sure it's in a liquid account, meaning it's not like in an IRA where you'd have to wait till you're 59 and a half to be able to take it out. It would just be in a regular investment account. And that's perfect, because and that is really important, and that's why I put that last question on there. Because sometimes when people come and they're thinking about their investments, they think about like all their different goals at once, instead of kind of thinking of their purpose of their money for each thing. So if you're like, for example, using the shortest term that I could think of in my head when I was preparing this was the saving for a down payment. It's more than you may want to save in a savings account that makes nothing. So you want to probably invest it if you've got it's 5 years down the road or something like that, or children's education. If you've got young children and you're setting up a 529 plan, that's got investments, that would be the same thing. It would just depend on how it is invested, whether you've got a whole bunch of stocks versus bonds. But you want to fill out and think about each time frame as part of what are you comfortable with for that investment. Like, are you going to, and the most thing about how you're comfortable is, are you going to stay invested if the market's down? And that's because that's when it's the easiest to pull it out. So you do want to think about what your investment profile is, and that really is the biggest questions that go into how you want to allocate your money. And think about the purpose that you want. So I picked some sample questions. The next 5 questions, you can kind of answer them in your head. I'll just kind of go through them of what it would look like in a risk questionnaire or a risk tolerance questionnaire that you would get. So here's one of them. So how soon will you begin to take distributions from this account? So are you looking to have to take money out like in less than 2 years, or more than 15 years. A lot of planners, financial planners, like to go in 10-year increments as far as planning for, and then you just keep reevaluating how long are you going to keep it in, what you need to do it for. The next question, how would you best describe your expected future earnings over the next 5 years? So are you expecting your earnings, and this is on the account. So do you want to outpace inflation? Are you expecting, you want to keep pace with inflation, you'll be happy with it? Or you expect your earnings to decrease? Of course, most people don't want that one. But it is a good question of outpacing or keeping pace, especially with what we're going through now with all this inflation this past year. Like I said, when I started in 2010 until this last year and a half, inflation was not even a question. I would have to bring it up and I'd have to say, inflation has a history of 3%, 2.8%. You have to think about inflation because in a savings account, your money makes nothing. So you have to do something with some of your money that you can help to, outpace inflation. But are you happy enough to keep pace with it? Or do you really want it to outpace inflation so that you don't have to worry about it? And then how long would your non-retirement savings last in the event of a financial emergency? And this is a good question when you're thinking about, I do want to start investing. I want to put some money away. I want to do it. You want to make sure that that money that you invest, especially in the market, in equities, is money that you don't need for an emergency. So you always want to have money set aside in a savings account for emergencies. And the 3 to 6 months is always what the rule of thumb is. Some pundits will say, at least get $1,000 in there to start. But whatever it is that you would need if something big happened in your life and you had to come through with a bunch of money, that's what you want to think of for your emergency fund. And then about how much of your monthly income do you use to pay installment debt? So, so those are the things like your student loan payments, your car payment, your mortgage payment, whatever it would be that you personal, any kind of personal loans, anything like that, because that money is pretty much fixed and you have to budget that to be fixed. And you don't want to have to use your investment money because the biggest downside is you don't want to have to pull out when the market's down. You have to use it for something. You want to be able to leave it in until the market recovers. And then the last sample profile that I put in was, are you willing to take on more risk for your investment performance to exceed inflation? This is a good question to think about. I used to say, or it used to be that always the younger you are, the more aggressive investor you are, and the older you are, the more conservative you go. And that's sort of true. I've met pretty conservative investors that are young, and I've met pretty aggressive investors that are older. So, but this is more like how comfortable are you with being uncomfortable? Like if you know that you need to have a certain amount of money by the time you retire, or you want to have a certain amount of money by the time you retire, are you willing to be more aggressive with your investments? So what happens after you do all of these profile questions? Well, you end up with an idea, a number. If your number is low, we might say you're on the conservative side. So a conservative investor usually has about 90% in bonds or cash or fixed things, and about 10% in the market, someone that's very conservative. And then on the other end, this growth investor, which has 100% in stock, we call them aggressive investors. And it's really a continuum. Right around in the middle where moderate is usually the 60-40 portfolio, which you may have heard of because they've been actually talking about it a lot, because last year was a year when the 60-40 portfolio really struggled, and it's been the benchmark for years. And that's 60% stocks and 40% of bonds or fixed things. I like this chart because this chart is something that you will see when you set up a 401k plan or a 457 plan. If you start somewhere and you're working and they put you in those plans automatically, where they and you don't fill out their risk profile, they'll put you in what's called a target date fund. And target date funds look like this. So if you're younger, and when you're younger and you start working, your target date fund is going to look a lot like this. And what you can see here is there is nothing of this white stuff called bonds or any of this yellow stuff that's called money market, which are your safest way, their safest investments. It's all going to be in some kind of stocks. And then as you get closer to retirement, that target date fund is supposed to move this way automatically. And you can see here, if we look here, wow, we got half of it's bonds and we got a whole bunch of thing in the money in the money market also. And that's because, you know, we're not looking for big growth then. We know we're going to be taking money out of it. So we want it to be more stable. And this is going to be more stable when you look at it. And this is exactly how asset allocation looks, is the different assets. You got large cap growth, those would be the companies and values. And you'll also, when you look at mutual funds, that's the way they will describe themselves also. All right, so key ingredients to the investment cake. I put a couple slides in here because we've been after such a tough year for the stock market and for people and their investments, that, you know, just as a reminder that market declines happen. We have had more up years than down years, but they do happen, and it's part of a cycle. It's part of the economic cycle, and we can't get away from it. Corrections are not all bad. In fact, they're kind of good because sometimes the prices are inflated in the market, and we want it to have some kind of a correction. So by and large, they aren't necessarily bad. And if we look at history, I put this chart in mainly because of this the S&P index return. If you look at that, you can see how many years are up versus how many green years are down. We always have many more years that are up. So your chances of being upside are much better than it being down. And if it's down, it usually goes up. We've got a couple that are not like that. That's not I was looking for 2021 to 1990. I have right in here. So 2000 to 2003 was the worst. It was even as far as years in a row that were down in the market. And then we had another net. It wasn't until 10 years later that 2008 happened, but it came back the next year in 2009. So, and this ends at 2019. So you can see the market goes up and down. If you stay invested, the trend is that over time it will go up. And staying invested is actually proven to be the most important thing, even more important than picking the right stocks. So market movement should be taken into consideration when you're planning. So what do we do though when we see the market go down? You know, we usually sell, and because emotion is in. And it's really hard to watch our money because our emotions are tied to our money. But it's not a good idea. The reason I showed that chart in the beginning was for this very fact that we don't want to chase last year's hot investment. If someone says they've got the hot stock picks, I would be very wary. Unless you want to, let's put it this way, if you like to research a lot and look up a specific company and find out all about it and you want to invest in it, go right ahead. But I wouldn't be looking to like one person or one source of advice just to have them tell you, oh, I think this is the next best thing, and then follow up and this is the next best thing. I mean, that's what's happened with crypto all these past few years, and a lot of those people lost a lot of money. And so, you know, and all because someone was saying it was the next best thing. So, you know, you want to and this picture, and I apologize, I don't know where the B came off and I couldn't fix it so that it would move correctly. But here it's showing you, you bought, let's say you bought here in the beginning and it's going up and you feel great. Well, it starts to come down, you're like, it's okay. It goes up a little bit, you get hopeful, oh, this is great, I'm still above what I bought at. And then it starts to hit down. And the problem is we don't ever know where the bottom is. And the pundits, even now, I get all those investment things in my inbox, and some of them are saying that we're done. Some of them say we're not done. We haven't hit bottom. We don't really know. We won't know until we start to go back up, unfortunately. But what happens? We get emotionally tied to it, and we sell at A. So we bought it, we've already lost money, and then we stay out of the market until it gets to be, you know, back up here again. And we're losing money all the way around, which is not a good place to be. So you really want to stay invested. And what are some ways that we can do that? Well, asset allocation is the big way and the easiest way, because you have, for long-term growth, if you got money in different asset classes, then you could, then if one is up, if one is actually, it's better to think of it as one is really down, another one will be up or will be stable. So you do want to stay invested and stick to a planned asset allocation model, which has historically beaten timing hands down. It used to be the 60-40. I don't think the 60-40 is going away, because it hits most moderate investors. It just happened to have a tough year last year, and that's 60% stocks and 40% bonds. Just to make sure I'm not just talking jargon. I don't want to be doing that. So what do we do? And right now, especially because the market's down, you know, a lot of people say, or there's a phrase that says, you know, the market's on sale when the market's down, because you can buy more shares of something for a lower cost. And then when it goes up, you've got more shares to sell. And so you've got, it'll go up. If you've got a tolerance for that, and that's okay with you, then it is like they're on sale when it's down. What most people do is a thing called dollar cost averaging. It's the reason why when you sign up for a 401k, you have money put in from each paycheck, so that you're buying whether the market is up or the market is down. And dollar cost averaging works for you. And let's see how that works. So here's 3 months. We're going to put in $100 every month. So in April, we put in $100. Each share that we bought was for $10. And so we bought 10 shares. In May, we still put in the same $100, but now our price per share has gone up to 15. So we could only buy 6.7 shares. And then in June, same $100, price per share is 13. And so the shares we could purchase was 7.7. Right, so altogether, we've got 24 shares. And if we were just to average the price per share, we'd come up with $12.67. But since we bought over all 3 months and purchased them at different prices, what we actually paid per share was $12.32. So we're saving money overall by dollar cost averaging. We also end up, you'll notice, when the price goes down again, we'll be buying more shares. So we'll have more, we'll just keep adding to however many shares that we have. And it's a great way. It really is the best way to be able to make sure that you stay invested, is to set up some way just to have money put in automatically. These are just a couple of do's and don'ts to keep in mind, and this is just good investment advice. You know, to look at how your things have performed. All reports, investment reports, will compare it to what's called a benchmark, which usually is the S&P 500, and you can see where your investments did compared to that. So that helps to give you an idea of whether you're doing better or poorly, or just how you're doing. The second one, you know, if you need to get money and raise money in the short term, you know, make sure you sell both losers and winners. Do rebalance. What rebalance means is if you've got that 60% in stocks and 40% in bonds, at the end of the year, if one of them is doing better than another, let's say you end up and you only have 50% stocks and 50% bonds. Well, your risk tolerance says, oh, you should be at 60-40. So what they'll do is they'll sell some of the bonds and they'll buy more stocks to get you back into alignment. And that is mainly so your long-term investment goals can stay on track. And then, keep track of economic news, but don't listen to every pundit that is on TV. We've got all sorts of business channels with all sorts of advice. Make sure that you just kind of stick to, this is what I know I need to do, and this is where I need to go. And stick to that, and keep in mind that people are trying to get ratings on TV, and people are trying to sell papers if they're writing something in the paper. So you want to keep that in mind with a headline or with anything else, and just kind of take it with a grain of salt, and take it for whatever larger picture you can take in. Like for the larger picture right now, the big debate's been, are we heading into a recession in 2023? That's been kind of the debate. Have we already started it? Are we in it? Those are the nuances. But the bigger question would then be, well, what does that mean for me? What do I need to do? Is inflation going to stick around? That would be another, big topic. And you can get lots of advice if you watch the TVs and but you want to stick to what the big picture is. Don't panic. Don't sell everything when the market's down. And this one's important because, we're talking about, the title is, investing on a tight budget. So you obviously don't want to use all of your available cash, hoping that the market's going to come back, especially when I just said that the market is considered to be on sale. You could call it on sale right now. You still want to always say, I've got my needs taken care of, and I'm going to put this much away. And that last one, again, don't listen to the Wall Street pundits. Just keep that in mind. All right, so I know a few questions came in about resources. So I put some together. This is not an exhaustive list, and I'm not really endorsing any of these. They are what they are, so I was just kind of wanted to go through them. So the first one is investor.gov. Investor.gov is great. And whenever you are looking for investment advice or any kind of advice that may have to do with something that the government controls or has oversight on, when you see the gov extension, it's a great place to go. And you can depend on it to be unbiased. It's really a nice site because they do little quizzes every month for your investment knowledge. They've got calculators to show you like compound interest and how that can affect your how it can affect your savings, whether you put a lump sum in or whether you put in a certain amount per month on top of the lump sum, and what you could have after a certain many years, depending. You can play around with the interest rate. So it's nice. It talks about how to, if you get to a place where you want to use a financial advisor, or you think about using a financial advisor, how do you compare them? That's on there. Different fees that you're going to run into when there is investing. So it's for straightforward information, it's a really great place to go. And then there's some, I'm calling them retail sites that are great to go to. There's lots of great information, but they also do a lot of advertising on different things. So, which means that they are making money somewhere. And so their advice is probably where they're making their money. So take their advice with a grain of salt, but they do have lots of really great information. The two best ones that people know usually are Motley Fool at fool.com and NerdWallet at nerdwallet.com. And they'll also, besides investments, they also will help with things like debt advice, credit card advice. They have advice on all sorts of things there. So it is good knowledge and a good place to go for a resource. Investopedia.com I like, especially if you have little experience or no experience. They do have, a free stock market simulator that you can join, and you can see what stocks you pick and how they would do. And so that's kind of fun. It also can help you think about, if it's way down, how do I feel? If it's way up, how do I feel? Am I tempted to sell? And you can kind of get an idea, without having to risk your own money, where you fit in the spectrum. So I really like that. And it does have a lot of great, if you're looking for a definition, Investopedia has got all the definitions for terms that you could use. So it's a great site for that. And then now, how much do you need to get started is going to depend on what kind of investment it is and where you invest. So I don't know what specific people's situation is, but I know that like when my son was a graduate student at Ohio State University, and he got paid, to get his chemistry PhD, he had access through the Ohio pension system to a 457 plan if he wanted it. A 457 plan is a great place to start, or it's just like a 401k plan in the sense of investments, because they'll take any amount to get you started. Usually you can do it as low as $25 or $50 a pay, which if you go to some of these other places like Fidelity or Schwab, to get into a mutual fund, they may want more like $2,500 or $5,000 to get invested. So it depends on where you want to invest and what you want to buy, to how much money that you really need to get started. If you don't have access to somewhere like that and you still want to start, then I know Robinhood doesn't need a whole lot of money to get started. Or you can always, like I said, start the savings account, take money and just have it money moved from your checking account into your savings account each month. Or at any of these places, I know at TD Ameritrade, you can set up a cash account and you can have money put into there. And then when it reaches a certain, whatever threshold you need to be able to buy what you want to buy, then you can just do it right on the platform. Fidelity, Robinhood, and TD Ameritrade, their platforms are or Fidelity and TD for sure, are really robust platforms. And you can they've got education classes on them. They will help you with the trading. You can look up any mutual fund or any stock and see how it's doing. You can, so it's great for information and learning as well as investing and it's a pretty intuitive investment platform when you say whatever you want to do to open the accounts. Robinhood, I am not as familiar with. I just know it has been popular, and I know you can use a smaller amount of money to be able to buy individual stocks. And sometimes people like to do that because that's a way to, especially with stock prices go up, like for big companies, to be able to buy into a company. Betterment, I put on there, it's kind of a unique platform. This is a great place if you want some advice and you want to have it more managed. It does have a cost involved, but it's very low cost. I don't work for them or anything, so I'm not promoting them as one over another, except for the people that have wanted to have some more advice and just, oh, I don't know what to do, have found it to be helpful and very easy and intuitive to work with. So I've sent several people there that have been very happy, that had smaller amounts and they wanted to get started. They wanted to have some kind of advice, but they knew they didn't have either the money, or they didn't want to pay for an advisor, or they really didn't need to pay for a financial advisor because they were just getting started. And that was a way for them to be able to get advice and to be able to get started with a less amount of money. So it's been really good for that. The two things Morning Brew, I mentioned, if you go to morningbrew.com and their brew brands, I get their morning brew every day for my profession, being a financial advisor. It gives me like how the stock market did, and it has like little pieces of advice and a company news. It takes all of 5 minutes to read every morning, so it's a great way to catch up on what's going on. But they have all sorts of different things to choose from, and they're free newsletters that the Money Brew newsletter comes out once a week or twice a week, and the Money with Katie are both just money and how to, they're also bigger picture with your money. It's not just investments and it's not just the stock market. Katie talks about all sorts of things, and she gives her opinion on what she thinks about is and debt, and she'll talk about credit cards, and she'll talk about loans, and she'll talk about all sorts of different financial things. And I really enjoy it because it's a completely different perspective than what I have, being that I work with a lot of people that are nearing retirement. So it's one set of questions, and she's usually talking to people who are starting to accumulate a lot of money. So she'll have a completely different perspective on something sometimes as me. So I find it very refreshing to read because I love to read different perspectives and to have different ideas and just to challenge my thinking. So I really enjoy her, and I find her it helpful, and they're free, and they don't inundate your inbox with lots of information. So we're right here at, oh, good. And we're looking at the time, and good, we're right here at the end. So did I miss any other questions, Debbie, or anything like that?
Oh yeah, we have one that just came in from Michael. Can you
Okay.
discuss more about the certificate of deposits and give some examples?
Oh, okay. So certificates of deposits are the CDs, and they're offered by banks. So you'll, or through financial institutions, because you can actually get them on like the Schwab platform, or if, and in Vanguard, I know they will have it. But the way they work is there'll be a different denomination. So they'll say, by thousands of dollars usually. So for $1,000, you would buy the CD. They'll guarantee you a 3 or 4% interest rate, and it will mature in a certain amount of months or years. So I know I've seen some of them on the platform that have been as low as 6 months, where they'll give you an interest rate and it'll mature, and then you don't want to touch it for that amount of time. So it's like putting it into a deposit that you're not going to touch. And then they can go out as much as 5 or 6 years. Right now, the ones that are in the longer ones have not been offering much in the way of interest rates. And so there's other options that you could use, but they are, since they're offered by banks, they are FDIC insured. So, you're not going to ever lose your money, but you'd be willing to take a smaller interest rate. It's because I just heard that noise. I don't know if that meant something else. Someone else said something or not.
No, I think some folks may have to go to work or
Okay.
class.
Yeah, I was gonna say, yeah, we're at the end. So I just want to remind you, this is the link. If you'd fill that out to do the evaluation, I would really appreciate it. Any feedback is great feedback and would be really helpful. And you can also reach me. I'm dmajor@sofausa.org. And there's my phone number. If you have other questions or you want to talk, that's fine. I always set aside time for SOFA attendees, for anyone that might have questions from the workshops. And thank you for having me today. I really appreciate it. I hope you found this helpful and you learned something and you are ready to go have some more confidence to invest.
I've been investing for years, and it's helpful to hear these things over and over again, because we just forget, we get caught up in the moment. So I particularly appreciated being reminded of things that I should double check on. And your illustrations, Debbie, were so helpful in explaining these concepts. So it was very helpful to me, and hopefully it was helpful to our new investors. So I can't thank you enough for helping us start off the workshops this way.
Oh, thank you. Thank you. Yeah, this was fun. This was great. So
okay, good. Well, thank you, Simone, who was in the background, who helped with some technical aspects of the workshop. And thank you to SOFA for connecting us with Debbie Major. And finally, thank you to everyone who joined us on Zoom today and those who are watching on YouTube. It's always good for us to spend some time together. I'm going to remind you to please do the survey. And our workshop next Tuesday is all about preparing for home ownership. So this was a good way to lead into home ownership, because I know it's going to take you getting your finances in order. So remember to sign up for our newsletter if you want a reminder about the upcoming workshops. And that's it for now. Have a good week. And as always, remember that Grad Legal Aid is here to help you. Bye-bye.